Welcome to our Taking Stock episode for the week ending the 10th of March 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jace. Reporting season is over, but it doesn't seem that way within our research team.
Definitely is. We've got our heads down and thumbs up, Kien.
Okay, but before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile and any historical performance figures may not represent future performance. So another month has gone and it's another interest rate rise. The cash rate is now at 3.6%, a level not seen over the last 10 years. And there is usually an inverse correlation between interest rate rises and equity markets. But this week, the Australian market reacted positively to the RBA announcement. And investors also welcomed Governor Lowy's comments that he could pause rate rises as soon as next month, Jace.
Well, Ken, the weaker than expected economic data, including GDP growth, wages, and a softer labour market, has really driven the RBA to temper its guidance around future interest rate rises. Financial markets are now evenly divided on the prospects of another interest rate rise next month, and they're pricing in a 52% chance that the RBA could hold the cash rate steady. As a result, analysts have lowered their expectations, with Australian cash rates now expected to peak around 4% compared to 4.3% earlier.
Yes, Jace, there is quite a stark contrast between Australia here and what is happening overseas. In the US, the Federal Reserve Chairman, Jeremy Powell, he suggested that US rates may need to move higher than expected. And this differing view on interest rate expectations between the US and Australia has led to a drop in the Australian dollar compared to the US. And a simple explanation for this is that investors, they tend to move towards US investments, which have higher yields, and that increases the demand for the US dollar.
And also, of course, a rise in the US dollar should benefit companies and star stocks with significant US earnings exposure. Amongst our portfolio of star stocks, these include resource companies like Woodside Energy, who receive commodity prices in USD, healthcare names including Cochlear, ResMed, and CSL. And those with global exposures such as Macquarie Group and Aristocrat Leisure should also benefit as well. You can find a regional breakdown of revenues under Golden Rule 7 principal activities.
Yes, that's right, Chase. Many companies with overseas exposures do tend to be growth stocks. And over the last 2 years, rising interest rate expectations have weighed on the performance of growth investors. And you can see this from the chart on screen, which compares the RBA cash rate, that's in grey, with 10-year bond yields in orange, and also the growth to value ratio, and that's in blue. And whenever this blue line rises, it means that growth is outperforming value and vice versa. So you can see over the last few months, we've seen a slowdown in the pace of bond yield rises, which is a proxy for interest rate expectations. And that's also leading potentially to a chance that the growth style will move back in favour.
Yeah, it's an interesting chart, Ken. And with this in mind, our team of analysts have been scouring the market for opportunities following reporting season. You would have noticed that we transitioned a few star stocks from borderline to star growth within our portfolios. The changes have been driven by a quant model, which has re-ranked stocks based on their financial metrics under Golden Rule 2, as well as a qualitative analysis on the outlook and active risks.
Yes, but just to keep in mind, that the transition to star growth stock doesn't mean that the fundamentals of the business has changed. Investors who are interested in adding these exposures really need to be comfortable with those active risks and the valuation under Golden Rule 5 as well. But speaking about star stock changes, we have recently included a traditional defensive income stock into our star growth stock universe, Jace. That's Telstra. So how can this be a growth stock?
Good question, Ken. And what has supported our investment thesis on Telstra's growth outlook is predicated on their mobile division, which represents nearly 60% of the group's earnings. The growth in mobile is driven by plan increases on the back of the inflationary environment, and this has been around 5% in the first half of FY23. Consensus is also projecting this growth momentum to continue into FY23 and also into FY24.
Right, there is some strong growth going on, Jace, but also, I guess, driven by a recovery in international travel, which should improve its roaming revenue streams as well. And along with that earnings contribution from its acquisition of Digicel Pacific, and that should help also drive double-digit earnings growth for the company over the next 2 years.
Well, that's right, Ken. Since the sale of its copper network to the NBN in 2012, wow, it's been a decade already, Ken. Telstra has demonstrated adaptability and fortitude in navigating its transformation towards a more dominant wireless telco communicator and operator with 40% market share. And even though the NBN receipts from the copper network has dried up in 2022, the company has managed to recover the earnings gap with a stronger focus on mobile and also slimming down its operating structure with the guidance of its Telstra 2022 simplification strategy, Ken. So the reason for this is helping improve its net profit margins as well.
Yes, we can see that under Golden Rule 2. But moving on from a relatively defensive stock to a higher risk one, let's have a chat about X-Star borderline growth stock, carsales.com now, which was in the news after they announced a 500 million capital raise. Just as a refresher, now carsales was dropped out of our growth model last month after reporting a significant pickup in debt levels, and this prompted its financial health rating to decrease from strong to distressed, Jace. So you were the covering analyst for carsales. We did forewarn investors about the potential risk of a capital raising and, of course, another potential acquisition, didn't we?
Yeah, that's right, Ken. This is definitely an interesting case. We did voice our concerns about carsales' high debt levels at the first half 23 results and the potential impact this could have on its ability to sustain its operations, especially as interest rate environment is getting a lot higher now. I feel like management have actually been cognizant of this fact. Hence, they plan to divert around $130 million of that $500 million equity raise to help reduce their debt levels.
Yes, and despite this, though, the risks are still quite significant, and we prefer to sit on the sidelines for now with this stock. Remember, the equity raise is expected to dilute shareholder equity by about 7%, and the company is using also that capital raising to take a 40% stake in Brazil's digital marketplace platform, Webmotors, but this is not expected to impact its earnings per share for the first year. Hence, there will likely be a decline in its return on equity from financial year 24 onwards. And now, with the reporting season over, there are no Star stock results next week on our corporate calendar, but Star Income stock Spark New Zealand, they are expected to go ex-dividend on the 16th of March, and the forward gross dividend yield on this stock is around 5.4%. Now, for Under the Microscope this week, we take a look at another potential opportunity, Johns Lyng Group, the insurance building and restoration services company. We recently reinitiated coverage of this stock after its first half result. Jace, what is the investment thesis on this stock, and why have we picked up coverage given the headwinds to the building sector?
Yeah, it's an interesting question as well, Ken. The investment thesis revolves around Johns Lyng's leading market position in the Australian restoration market, and they also service insurance company claims as well. The beauty of this market is that it is defensive and not reliant on a strong economy or effectively changes in that economy. And that is because insurance claims are made throughout the economic cycle. Furthermore, Johns Lyng has been a beneficiary of the recent weather events in New South Wales and was recently awarded a $140 million contract for insurance repairs. Now, increased catastrophe revenue led the company to upgrade its FY23 guidance by around 12%, and this was a catalyst for our initiation.
Quite interesting there, Jace, but having a strong market position usually means the company has high net profit margins. But if we look at its metrics on Stock Doctor, we can see that its net profit margins are typically quite low, between 2 and 3%. So do we see this as a significant risk due to the inflationary cost pressures within the building and construction industry?
Yeah, you raise a good point, Kien. Johns Lyng's operations are very thin margined. However, these insurance restoration contracts are awarded on a cost-plus model, whereby inflation cost pressures are passed on to the insurance companies, and Johns Lyng typically makes around a 10 to 12% profit margin before interest and tax costs. Additionally, the company's net profit margins are somewhat understated due to its partnership model with its subsidiaries. Net profit margins, excluding the impact of these interests, are around 5.3%, and this is much more attractive and in line with the industry average.
Yeah, well explained, Jace. And that is why having an analyst thoroughly review the accounts is essential part of our stock selection process. So, Jace, what are some of the key active risks for this stock then?
Well, Kien, there has been an increase in director selling as of late. The CEO, Scott Didier, sold 4 million shares in October 2022. Whilst we don't really like seeing executives sell down their stock, we understand that JLG has upgraded their guidance, and that provides us a bit of comfort around business confidence. So you can view the active risks that we've highlighted next to the key events tab.
Jace, I also noticed that Johns Lyng's financial health does deviate on the edge of failing at times. But this is really typically due to the company outlaying a large amount of capital for those catastrophe events when they occur, and then receiving cash flow payments from its customers at a later date. So while this isn't ideal, it is an important competitive advantage for Johns Lyng, as many smaller competitors are unable to fund the working capital for these catastrophic events. And now, with reporting season done and dusted, a few of our members are asking, how can Stock Doctor help me find the winners from the reporting season? Well, investors can look for star stock opportunities by using the stock filter tool, which lies under the Tools tab. Here you can build your own filter or select from a list of predefined filters such as star growth stocks or star income stocks.
For growth stocks, within the field list, make sure you include earnings per share growth 1 year forecast, price change 6 months, and also technical indicators such as SD30 TSR or the SD Max, price to consensus target, and EPS forecast 1 year, 3-month revisions. Once you have included all this, sort the list by 3-month revisions.
Yes, in general, upgrades to earnings estimates means that these stocks perform well during the reporting season. And to look for opportunities, you can filter stocks with stable or rising earnings revisions, but and also include those that breach the SD30 TSR, or you can even look for companies with strong earnings revisions but are trading at a discount to consensus share price targets. And some of these include, for instance, Bendigo and Adelaide Bank, AUB Group, Hub24, Lovisa, CSL, Helia Group, Kelsium Group. We recently initiated that stock, and Johns Lyng, of course, we covered that earlier today. But these stocks appear to be trading at quite a large discount to their consensus price target.
And of course, Kien, don't forget about the income investors as well. So within the filter criteria, you can include gross dividend yield forecast, franking, forecast dividend payout ratio, and days to ex-dividend. Here, you can sort companies by the highest gross dividend yield and look for those with stable 3-month earnings revisions. Some of the opportunities from this list also include Helia Group, Macmillan Shakespeare, DDH1, doTERRA Royalties, Suncorp, Telstra, the major banks, and a couple of our REITs.
Yes, Jace, there are plenty of opportunities there, and our Stock Doctor filter tool allows you to search for these. It's quite powerful. But again, that's all we have time for today, Jace. Thanks for your contributions. I know over the next few weeks, you'll still be exploring opportunities as we speak.
Definitely, Kien. Look, it's a pleasure as always.
And just a reminder that our Lincoln Live is on Monday. So we've got our team of experts, including Tim Lincoln, Matthew Swartz, our Senior Portfolio Manager, and Rob Manfrey, our Technical Expert, and of course myself, there to help you navigate these markets and answer all your questions. So to summarize today's episode, now markets will continue to be dictated by the changes in interest rate expectations. But of course, volatility creates opportunity, and Stock Doctor can help you look for those opportunities, especially using our powerful filtering tool by overlaying those earnings revisions to those valuation metrics. Take care and have a happy, healthy, and prosperous week, everyone.